So we'll begin now with another interesting and important review for the FRM exam that deals with options and option strategies. So if I am positive on a stock, that is, I feel that the stock price is going to go up, what are the different instruments that I can use to execute this view or to profit from this view? First option is to go and simply buy the stock or long the stock in the spot market, so that when the stock goes up, the long position will gain. Another instrument that we could use that we studied in the previous session is called a forward. So the long party in a forward contract, as we studied, will gain if the stock price goes up. The short party will lose as the stock price goes up. With both these instruments, the only problem is that what if my view goes wrong? What if the stock actually falls? So with both these instruments, what if my view goes wrong? I will have to suffer a loss, because if the stock falls, then whether I long the stock or whether I long a forward, in both cases there will be a loss, because a forward is also a right as well as an obligation. So I have the right to buy, and I will have to buy at that price, and I will sell at a lower price if the stock price goes down. Now if I want to limit my downside or not have this downside, then I can execute my view of a positive stock by buying an option, or more specifically by buying a call option, which is a right but not the obligation to buy. So if I have a call option with a strike price of $100, then at maturity or at a point, I have the right to buy this stock at $100 but not the obligation to buy. That is, if the stock price is 150, yes, I will exercise my right and buy it at 100. If the stock price is 90, I will not exercise it, because in the market it is available for 90. I will rather buy it from the market at 90. So remember, options, as the name suggests, is an option to buy or sell. A call option is the right but not the obligation to buy. A put option likewise is the right but not the obligation to sell. The person who owns the right or who has the right is referred to as the buyer, and the person who has given the right, that is the other counterparty, is called the seller. Please note that in this transaction, the seller only has downside, because if the stock price is low, the buyer won't exercise his option. If the stock price is high, the buyer will exercise. So the buyer in this contract only has an upside, and the seller in this contract only has downside. To write an option or to give this right, hence the seller charges an upfront premium. Upfront implying it is paid right on the day that the contract is written or the contract is signed, and the buyer who owns this option, call option or a put option, that is whether he buys the right to sell or he buys the right to buy, the seller of the option, the buyer of the option, will pay the seller an upfront premium. We'll study all these concepts in more detail, but just understand the crux of the introduction being that options, unlike forwards or unlike stocks, even though are derivatives, that is, they derive their value from an underlying, but they represent only a right and not the obligation. So it is an option with the buyer. The seller, on the other hand, will only have an obligation. The seller has no rights. He only has obligation to do whatever the buyer is doing, or to take the opposite side of whatever the buyer is doing. So if the buyer chooses to exercise his call option, that is, he chooses to buy, the seller will have to sell. In a put option, if the buyer of the option or the holder of the option chooses to sell the stock at $100, the seller will have no option but to buy. So once again, call option is the right to buy, put option is the right to sell, delivery price is also called the strike price. An American option is an option that can be exercised any time until maturity. A European option can only be exercised at maturity. We will use capital K to represent the exercise price. We will use small c to compute the value or to represent the value of a European call option. Value simply means the premium that needs to be paid upfront. Capital C will be the value of an American call option that can be exercised anytime until maturity. Small p will be the value of a European put option, and capital P will be the value of an American put option. We will use these notations extensively in today's session, and you'll understand as the slides pass. Now let's understand the payoff on a long call. So let's assume that I purchased a call option with a strike price of $100 and a premium of $10. Please note, this premium I would have had to pay upfront. So I paid the seller a premium of $10 and I got the right that if I want, I would be able to purchase this stock for a price of $100. Please note that this is a European option, so it can only be exercised at maturity. Now the payoff diagram that we are seeing here, the y-axis is the payoff, that is the profit or the loss on the option, and the x-axis is the spot price at expiration. So this graph is being drawn at maturity. So let's assume this was a 3-month option. So this graph is being drawn at the end of 3 months, that is at maturity. The option was the right to buy at a price of $100 if I so desire. Now if the spot price ends up at $100 exactly, then whether I exercise or I don't exercise, it doesn't matter. I will still have to pay a price of $100 because in the market also the price is $100 and the option also gives me a price of $100. So in this case, there will be no incremental profit or loss on the option. The thin line represents the incremental profit. The dark black line represents the total profit on the option. However, for the long, that is for the buyer, he has already paid a $10 upfront premium, so his total loss would be minus $10. If the stock price ends at $80, that is at maturity, let's assume 3 months was the maturity. So 3 months later, the stock actually ends at a value of $80. Now, would the buyer exercise his option? If he exercises, he will have to pay $100 to buy. If he doesn't exercise, from the market he can buy at $80. He will not exercise, he will rather buy it from the market at $80. Hence again, the option expires worthless, or the buyer will lose his premium of $10 that has been paid upfront. So again, the loss will be minus 10. In all cases where the spot price ends below the strike price, the loss will be equal to the upfront premium paid. The buyer can never have any additional loss because it is a right and not the obligation. So he can choose not to exercise his option, unlike in a forward contract where there would have been a greater loss had the stock price gone down to a long party. So this is when the spot ends up lower than the strike. If the spot ends up greater than the strike, so let's say the spot ends at $120. In such a case, the buyer will exercise his option because he has the right to buy at 100 and he can sell in the market now for 120, thereby gaining incrementally on the option a value equal to $20. However, $10 has already been paid as premium, so that will have to be knocked off from whatever is the profit, giving a total profit of $10. As the stock price goes up, if it goes to 150, the payoff will become $50 incrementally, that is 150 minus 100 minus 10 that has already been paid, making a total profit of 40. Please note, this $10 is not paid at maturity. This $10 is paid at initiation of a contract. That is, right at the beginning we will pay this $10. So we can write that the value of a call option at maturity, or the incremental payoff from a call option, can be given as maximum of S minus K comma 0. That is, if S is greater than K, the payoff will be S minus K. If S is less than K, then payoff will not be negative. It will not be S minus K negative, it will simply be 0 because the buyer will not exercise the option. So this was the payoff on a long call. Please similarly try to draw the payoff on a long put, a short call, that is the seller of the call option, and the short put. Assume the same strike price, the same premium. Try to draw the payoff profiles for these three instruments: long put, short call, short put. Y-axis needs to be the payoff and X-axis is the spot price at expiration. We are assuming European options for the time being. That is, the option can be exercised at maturity. Now let's first try to draw the long put. So a put option is the right to sell at a price of $100 in our question. Again, if the spot price ends equal to the strike, that is, it ends at $100, it doesn't matter whether the owner exercises the option or not. In the market also he can sell for $100 and to the counterparty also he can sell for $100. So there will be no incremental payoff. However, he has paid a premium of $10 to begin with. To buy the put option, he again had to pay a $10 premium, so his loss would equal to $10. That is the premium pay, that is the total loss. Now for a put option, if the spot ends up greater than the strike, that is, the spot price ends at $120, wherein the strike price is $100, would the buyer exercise the option? Would he sell at $100 to the counterparty, or would he sell at $120 in the market? He would rather sell in the market. So if the spot ends up anywhere greater than the strike, then the buyer will not exercise the option. He will rather sell in the market. So at any point greater than the strike price, the buyer will forfeit the option, or he will let it expire worthless. His total loss will simply be the premium paid on the option. So $10 will be his total loss in case the spot ends up greater than the strike, because he will not exercise the option. If the spot ends up below the strike, let's say the spot ends at $80. So in the market, the owner will be able to sell the asset for $80. However, because he has a contract which gives him the right to sell at 100, will he exercise his right? So he will exercise the right and sell it at $100, thereby making a profit of $20. That is to say, he can buy at 80 from the market and sell at 100. So the profit at 80 would be an incremental value of $20. However, he has paid $10 premium upfront. So the total profit would be 20 minus 10, that is $10. Similarly, at $90, would he exercise the option? Yes, he will exercise because he has the right to sell at 100 and he can buy from the market at 90. So he'll buy at 90, sell at 100, making an incremental profit of $10. However, $10 is also the premium that he has paid, so his total profit will be 0. So the red line is the payoff on a long put. That is the total payoff. The dark line or the dark black line was the payoff on the long call. Similarly, let's try to plot the payoff on the short call. So the short call is the writer of the option. So he is the counterparty who has given the option to the long. Now he has to take the other side of the trade, whatever the long chooses. If the spot is lesser than the strike in a call option, will the buyer exercise the option? So please, we are coming back to a call option now. This was the payoff on a long call. It is the right to buy. He will exercise it only if the spot is greater than the strike. Otherwise, he'll buy from the market. So if the spot is lesser than the strike, that is, if the ending price is lesser than $100, then will the buyer exercise the option? He will not, or the seller of the option will simply enjoy his $10 premium. Till the time the spot is less than the strike, the seller will enjoy his premium. As the spot starts moving above the strike, the buyer starts coming in the money. Remember, seller never comes in the money. It is only the buyer who can incrementally make profit. The buyer's downside is limited to the premium. Similarly, the seller's upside is limited to the premium. As the spot moves above the strike, let's say the spot becomes 110. The buyer will buy at 110 and sell in the market at, the buyer will buy at 100 from the counterparty or the seller and sell in the market for 110. Or the seller will have to buy at 110 and sell it to the buyer of the option at 100. So he has the obligation to sell at 100, because if he buys at 100, the buyer, somebody has to sell him. The seller will sell at 100 and actual price is 110. So he is buying at 110 and selling at 100, thereby making a loss of $10. However, he also received a $10 premium, so his total loss will be 0. Similarly, at 120, his total loss will be $10. The buyer's total profit was $10. At 130, so on and so forth. Please note that the long call and the short call will have payoffs that are mirror images of one another along the x-axis. Derivatives, remember, are a zero-sum game. So one counterparty's profit is exactly equal to another counterparty's loss. That will be the case with the long call and the short call. Finally, let's try to draw the payoff of the short put. So the red line was the payoff on the long put. So once again, the put option is the right to sell at a pre-decided price of $100 in our case. The holder of the put option will exercise when the spot is lower than the strike. That is, he will sell at 100 and he will be able to buy at a lower price. If the spot ends up greater than the strike price, then the holder will not exercise the option, because why sell it at $100 when in the market you can sell it at a higher price? Put is the right to sell. The seller of a put option will have to take the other side of the trade. That is, he will have to buy in case the seller exercises his option. So if he sells, the counterparty will have to buy. If the spot ends up greater than the strike, the buyer will not exercise the option. Hence, the seller of the option will simply enjoy his premium. This was the loss to the long put. This will be the profit to the short put till the time spot is greater than the strike. As the spot goes below the strike, so let's say it goes to $90. Will the holder of a put option or the buyer of a put option exercise it? Yes, he has a right to sell at $100. He will exercise it. He'll sell at 100 and buy at 90, thereby making a profit of $10. For the short counterparty, it will be the other way around. He will have to buy from the counterparty or from the holder at $100 and sell in the market at $90, thereby making a loss of $10. But $10 is also the premium he received, so his total loss would be 0. Similarly, if the stock price falls to $80, the buyer will have $20 of profit. He will sell at 100, buy at 80. Seller will have $20 of loss. He will have to buy at 80 and buy at 100 and sell at 80. So again, the blue line is the payoff on the short put. Please note, the long put and the short put will again be mirror images of one another. So let's take a look at all the 4 payoff diagrams once. This was the payoff on the long call. If spot is less than strike, just lose the premium. And as the spot moves above the strike, you gain because you buy lower and sell higher. In a long put, till the time spot is greater than strike, you don't exercise, because you have the right to sell. So if the spot is higher, you'll sell in the market. If the spot is lower than the strike, then you will sell to the counterparty at 100 and you'll be able to buy at a lower price, making a profit. So long call gains when the spot moves up. Long put gains when the stock price moves down. The payoff to the short call and short put would be exactly mirror images. Till the time the option is out of the money, we'll explain it in more detail, but till the time this buyer doesn't exercise, the seller will realize his premium. As the buyer exercises the option, the seller will start losing to the extent that the buyer gains. Similarly, for the short put, to the extent that the buyer does not exercise the option, you would enjoy your premium. As the stock price falls and the buyer gains, the short put would have an equal amount of loss. So that was an introduction to the 4 types of options, rather the 2 types of options and the 4 positions that can be taken. Call option is a right to buy, put option is a right to sell. So payoff on a call is equal to the spot minus the strike. That is, as the spot price goes up, call option gains. Payoff on a put is given as the strike minus the spot. So if $100 was my strike price and $80 is the spot price, then the incremental payoff will be 100 minus 80. If the spot goes above the strike, then the payoff from a put doesn't become negative because it is an option. So the buyer will simply not exercise the option and hence the payoff will be 0. Please note, these are incremental payoffs. Premiums have to be paid upfront. So whatever is the premium is paid right at the beginning of the contract. So remember, S minus K is the payoff on a call, K minus S is the payoff on a put option. Now, arguably the most important relationship in the review on options and option strategies would be the put call parity. The put call parity can be derived in many ways. We will study one method of deriving it. You can imagine many different portfolios and derive the same equality. So let's imagine two portfolios. Portfolio 1 has a long call, a short put, and an investment at the risk-free rate. So these three instruments comprise portfolio 1. And portfolio 2 is simply long the asset or buy asset. Now let's try to calculate the final payoff of both portfolios 1 and portfolio 2. At maturity, there are two possibilities. First, that the spot price will be lower than the strike price, or the spot price will be greater than or equal to the strike price. So if K is any number, then S will either be less than that number or it will be greater than that number. There is no other possibility. Both the call and the put have the same strike price, that is K. So first, at maturity, all these options are European options, that is they can only be exercised at maturity. So at maturity, what will be the payoff from the first portfolio? Let's first do it if the spot price is lesser than the strike price. Will the call option get exercised? Call is the right to buy. So if the spot is less than the strike, why will I buy at K? I will rather buy at S from the market. So the payoff on the long call is 0. We also had a short put. Please note, the short has no rights. Rights are with the buyer of the option. So if S is less than K, will the buyer of the option exercise the put option? Yes, he will sell at K. Put is the right to sell. He will sell at K and buy at S. So K minus S will be the profit to the buyer of the option. To the seller, there will be an equal amount of loss. We are talking about incremental payoff only. He would have received some premium, but that is upfront. Incrementally, he can only have a loss. His incremental loss would be minus K minus S. Assuming we invested K e raised to power minus RT at the risk-free rate, where R is the risk-free rate of interest, how much would this become at maturity or after a time T? It would be K e raised to power minus RT multiplied by e raised to power RT, this amount multiplied by e raised to power RT, or it will simply become K. If you invest so much money, then after a time T, it would become K e raised to power RT, or if you invest K e raised to power minus RT, it will become K. So if the spot ends up below the strike, then the total payoff from the first portfolio will be 0 minus K minus S plus K, that will simply be equal to ST. If I sum these three values up, please note, we will explain later as to why we are doing this, and you'll understand very soon. Just for now, try to understand that this is a portfolio that has been created and try to compute the final payoff of this portfolio. If the spot ends up greater than or equal to the strike, then again there are three instruments. Let's see the payoff on each of the instruments and sum it up. On the first instrument, that is long call, what will my payoff be? Will the call option be exercised? Because the spot is greater than the strike, so I will buy at K and sell it at S. So S minus K will be the payoff on the long call. Will the put option be exercised? Will I sell it at K or will I sell it at S if S is greater than K? I will rather sell at S, so the buyer of a put option will not exercise the option. So the incremental payoff on the put option will be equal to 0. If I have invested K e raised to power minus RT in a bank, then that money will simply become K at maturity, or the total payoff if the spot price is greater than the strike price also comes out to be S minus K plus K, that is equal to S. S is the spot price at maturity. So the payoff of the first portfolio we saw, in both cases, whatever be the final spot price, the eventual payoff is simply equal to the spot price. In portfolio 2, we purchase the asset today. So if we purchase the asset today, what will be the value at maturity? It is whatever is the spot price at maturity or whatever is the price of the asset at maturity. So what we are arguing now is that both these portfolios have the exact same payoff. That is, both give us the exact same value at maturity. If they give us the exact same value at maturity under all circumstances, whatever be the S, under all circumstances the payoffs from both these portfolios is equal to ST, that is the spot price at maturity. Then what should be the price of constructing these portfolios at t equal to 0? It should be the same. Otherwise there will be an arbitrage opportunity. Whatever is cheaper you can buy and whatever is expensive you can sell and make free money, because both are giving the same payoff at maturity. So by the no arbitrage principle, the price of both these portfolios must be the same to begin with. Now cash outflows from our portfolio are denoted negative. Cash inflows into our portfolio are denoted positive. To buy a call option, will I pay the premium or will I receive a premium? So I will pay minus C, that is the premium on the call. If I sell a put option, will I receive the premium or pay the premium? So I will receive P, that is denoted as plus P. And if I invest K e raised to power minus RT in a bank, today is it an outflow or an inflow? Because I've invested this money and that is why so much comes back to me in the future. So minus K e raised to power minus RT is what you have invested. So the total cost of making portfolio 1 is minus C plus P minus K e raised to power minus RT. The cost of making the second portfolio is simply the spot price of the asset today. So if I buy the asset or I buy the stock, then whatever is the price today is what I will have to pay. And at maturity, the value will be whatever is the spot price at maturity. So portfolio 1 should have the same cost as portfolio 2, and the cost of portfolio 2 is S. Hence these two must be the same. If we rearrange this equation, that is I bring S to the left and C and P I take to the right, this can be written as C minus P will be equal to S minus K e raised to power minus RT, arguably the most important relationship called the put-call parity. Relates the premium of a call option to the premium of a put option, works only for European options. That is, these options could only be exercised at maturity. In other words, we can say that a long position in an asset, portfolio 2, is simply a long position in an asset that is equivalent to a long position in a European call option with a short position in an otherwise identical put combined with a risk-free investment or a risk-free position. It has far-reaching implications, this formula. You don't need to remember the proof. This is one way of proving it. There are many other ways. Different books give different ways of proving the put-call parity. You have to remember the put-call parity. That is, C minus P is equal to S minus K e raised to power minus RT. C is the premium of a call option. P is the premium of a European put option with the same strike price and same maturity. S is the current spot price. That is the spot price today. K is the strike price of the calls and puts. E raised to power minus RT, where R is the risk-free rate and T is the time to maturity of the options. Please note that if the asset was a dividend paying asset with a continuously compounded dividend yield of R star, then in all formulae replace S by S e raised to power minus R star T, or if it's a discrete dividend, replace S by S minus the present value of the dividend. We studied that in the review on forwards and futures. We proved it. Please remember that in all formulae and derivatives, if the stock is a dividend paying stock, replace S by S e raised to power minus R star T, or if it is a discrete dividend, replace S by S minus the present value of the dividend. R star here is the continuously compounded dividend yield. R is the continuously compounded risk-free rate. So let's do an example. Given a situation where the current stock price is $80, the risk-free rate is 8%, a quote is found for a 3-month put option with an exercise price of $75. The put price is $5, but due to insignificant trading in the call options, there was not a listed quote for the 3-month $75 call. Estimate the price of the 3-month call option. So we have a price for the put and we need the price for an identical call. Hence, we can use the put call parity assuming both of these are European options. For American, it won't work. So we will say C minus P is equal to S minus K e raised to power minus RT. What we need is the C. We are given all the other inputs. So C can be written as P plus S minus K e raised to power minus RT, where P, that is the price of the put option, is given to be $5. The current stock price is given to be $80 minus the exercise price of $75 into e to the power minus R. The risk-free rate is 8%, multiplied by the time to maturity, that is 3 months, that is 3 by 12. So it will be 85 minus 75 into e raised to power minus 0.02. So first let's compute e raised to power minus 0.02. So press 0.02, press the button plus minus, press second and press ln. Multiply this with 75 and we'll subtract 85, which will give us the value of the call option as $11.48. So this is the first application of the put call parity, that is, given the price of the call, you can derive the price of the put and vice versa. A very important application comes in creating synthetic positions. Now let's understand, and please remember this explanation well. Your books don't explain it like this. This is a nice trick to solve any question like this. So the question asks, according to the put call parity, writing a put is like, and there are 4 options given. Now please see how you will solve this question. First, understand what you need. You need writing a put. Writing a put means you are selling the option, or you're selling a put option. If you're selling a put option, will it be represented as plus P or minus P? Will you receive the premium or will you have to pay the premium? We will receive the premium, hence it will be written as plus P. Once you've identified what you need, go to the put call parity and bring what you need on the left hand side. So we'll bring plus P on the left hand side and then compute what the right hand side is. So plus P, so if I take P this side and bring everything this side, would be equal to plus C, that is the C remains here, minus S plus K e raised to power minus RT. You need writing a put. So writing a put is plus P. Now we will write all the remaining in statement form. Plus C means writing a call, not buying a call, because buying a call would be minus C, you'll have to pay the premium. Writing a call would get you plus C. Minus S would mean buying the stock, because if you buy stock you'll have to pay S. Plus S would be shorting the stock, so it will be buying stock. Plus K e raised to power minus RT means you are borrowing at the risk-free rate. That is why there is a cash inflow into your portfolio. So writing a call, rather writing a put, is like writing a call, buying stock and borrowing at the risk-free rate. Writing a call, buying stock and borrowing. Option B. Any question of this format you will solve like this. This position is referred to as a synthetic put. That is, if I want to short a put option, I can simply short a put option, or I can short a call, buy stock and borrow at the risk-free rate. That will also create the same payoff as a short put position. Very similar to what we did in proving the put call parity. So writing a put will have the same payoff as this right hand side, or this right hand side is called a synthetic put option. Using the same method and the same technique, please derive what is investing in the risk-free rate like. Using the put call parity, please derive what is investing at the risk-free rate like. So investing at the risk-free rate would be plus K e raised to power minus RT or minus K e raised to power minus RT. If we invest, it will be a cash outflow, so it will be represented as minus K e raised to power minus RT. So then we just need to go to the put call parity and see what minus K e raised to power minus RT looks like. So let's keep minus K e raised to power minus RT on one side. This will be plus C minus P minus S. So plus C is nothing but writing a call or selling a call option. That's when you will receive the premium. Minus P is like buying a put option because you're paying the premium, and minus S is like buying the stock. So it's a very interesting synthetic position. What you have done is that you have created a risk-free payoff. The payoff on the right hand side will be exactly the same as the payoff on the left. So if you want to create a risk-free position, and let's say you're not allowed to invest in the Indian bond markets. Let's say you're a foreign investor who wants to enjoy the high interest rate in India, but government doesn't allow easy access to foreigners in the bond market. However, equity markets are open and derivatives markets are open to foreigners. You can create a synthetic risk-free position by writing a call, buying a put, and buying the stock. So if you write a call, the payoff will be, or it will be written as plus C minus P minus S. So by only being in the equity markets, you have created the same payoff profile as the risk-free rate. So you will apply the exact same method to calculate any synthetic position. So if the question asked long call, short call, long put, buying stock, investing in the stock, you just have to rearrange these terms and figure out what is it going to be. The next question is similar to the put call parity that we studied. So a European call option price is given, strike price is given, underlying stock price is given, risk-free rate is given, the dividend yield is given. What is the number closest to the market price of a 2-year European put struck at the same strike price? We will again apply the put call parity and compute the value of the put option now. So C minus P is equal to S e raised to power minus R star T minus K e raised to power minus RT, where R star is the continuously compounded dividend yield that is given to be 2%. R is the risk-free rate given to be 5%. So once again, all other values are known. C is 50 minus P is equal to 100 e raised to power minus 0.02 into 2 minus K, that is 140, into e raised to power minus 0.05 into 2. So please solve this question and please verify that the price of the put option will come out to be approximately $81. The price of a non-dividend paying stock is $20. A 6-month European call option with a strike price of 18 sells for $4. A European put option on the same stock with the same strike price and maturity sells for $1.47. The risk-free rate of interest is 6%. Are these securities consistently priced? So we just want to check that is C minus P equal to S minus K e raised to power minus RT. If it is, they are consistently priced. If not, then they are not consistently priced. That is, let's compute the call option in the synthetic manner and let's verify what the actual price of the call is. If it is the same, that means they are consistently priced. Otherwise, there is an arbitrage opportunity. So the price of the put option is given to be how much? $4. The stock price is given to be $20. The strike price is given to be $18 into e raised to power minus 0.06 into T is, please note the rate is always in years, so T also has to be in years. 6 months will be 6 by 12, that is 0.5. So please compute the value of the call option. Please note the price of the put is given to be 1.47. So the price of the call comes out to be equal to $4, more or less. That means the options are consistently priced according to the put call parity, or there is no arbitrage opportunity in this situation. Now let's change the question a little bit and let's make the price of the call option as $6. Everything else remains the same and the price of the call option now has become $6 in the market. Is there an arbitrage opportunity and how will you make profit from it? So in the market, the call is worth $6, and synthetically the price of the call comes out to be $4. To exploit the arbitrage, buy cheap and sell expensive, what we will simply do is that we will buy a call option and we will sell a call option so that there is no risk. We have it and we have sold it. But we'll buy the call where? In the market or in a synthetic manner? Synthetic. And we will sell a call in the market. When we buy the call, we will have to pay $4, and when we sell the call, we will receive $6 because that's what the observed market price is. So on one call, we will earn $2 of free profit. On a million calls, we will earn $2 million of free profit. Buying a synthetic call is very simple. It simply means take the opposite of this position. Buying a call is minus C. So minus C can be calculated as minus P minus S plus K raised to power minus RT. So take these positions, your effective payout would be $4 and it will be the same as a call option. When you sell the call in the market, you will receive $6.